Hi, everybody. November 29th, the Market Update Desk, Scott Riley and Mortgage One. We're going to talk today about trained economists versus attorneys. Now, it happens yesterday that we had two voting members. Now, keep in mind, there's only 12 voting members total that vote on monetary policy for the Fed. We had two of them talking yesterday. We're going to show the stark differences of people that are actually trained, studied, and educated in this facet versus ones that do not have the background. First, we're going to talk about Fed member Waller, voting member, keep in mind. Now, he is a highly trained economist. Now, granted, he hasn't been outside of government, but he is an actual trained economist. His comments were, I am increasingly confident that policy is currently well positioned to slow the economy and get inflation back under 2%. Also, reasonably confident of doing so without a sharp rise in unemployment, which is now 3.9%. If the decline in inflation continues for several months, 3 months, 4 months, 5 months, we could start to lower the policy rate because inflation is lower. There is no reason to say we will keep it really high. These are direct quotes from Fed member Waller. Now, remember, he's a trained economist. What he's telling us is that rates are sufficiently restrictive right now. And he mentioned 3, 4, or 5 months of lower inflation. We're now at 2 months of lower than predicted inflation. So we could be talking, as we've discussed in multiple episodes, potentially March, a rate cut. That would be huge. Now, this is in contrast to what voting member Michelle Bowman spoke about yesterday also. Now, keep in mind, she's a lawyer, attorney, not a trained economist, not educated on economy. In fact, her only background in economics is working at her mommy and daddy's bank in Kansas. Think about that for a minute. One of 12 people in the world that get to vote on the largest economy's Fed policy, monetary policy, and she worked at mommy and daddy's bank, and that's her only background. She's an attorney. So here's the contradiction statement. Economy has remained strong. Inflation progress has been uneven, and most recent jobs reports have showed healthy job gains. My baseline economic outlook continues to expect that we will need to increase the Fed funds rate further to keep sufficiently restrictive to bring inflation down to 2% target rate over time. Holy smokes, what data is she looking at? We've seen incredibly weak employment data, especially when in regards to full-time versus part-time. We've seen the trend line lower consistently for job growth. In fact, we've seen multiple revisions and we've seen declining inflation numbers. Where is she getting this? Now, this is the stark difference of economists versus attorneys. Now, these are the hawks and the doves. In fact, up until recently, Waller was really on the more hawkish side. He has now turned the corner to say, hey, it looks like we've got to where we need to be, and we're going to start to lower rates. Now, if we can get to a point where we're starting to see lower Fed funds rates, a decline, starting in March, April, May, we will most likely also see the Fed start to decelerate or stop quantitative tightening, or QT. This will give additional benefits to the bond market. If QT can end, that would be a huge upswell for the bond market. Now, another report we got today was second look at third quarter GDP. Now, surprisingly, the second quarter reading showed that the U.S. grew at a 5.2% annualized pace, which was hotter than the 5% rate that we expected. Interesting. This came in higher. Where did this expansion come from? You guessed it. The strong Q3 GDP was primarily because of upward revisions to non-residential fixed investment. And here's the big one, government spending. Now, Peter Bookvart, highly trained economist out there and contributor, listed that this is unsustainable And that with such high Q3 comparisons, thinks we could actually see a significant slowing in Q4 and potentially see a negative number in Q4. Government spending is not sustainable, and that's what's been spurring everything. Now, when we dive into this report, we do see that both consumer spending and imports declined in Q3. This will help us as far as inflation numbers. Now, tomorrow, we get the all important PCE report. We are expecting, hoping for a less than expected number in PCE that would benefit significantly the bond market by showing less inflationary pressure. In fact, right now, the bond market, as we're looking right now, is at 4.26. We the movement down on this has been staggering. We talked about the shorts out there that were pushing the bond market up. They have been taking it. Thank goodness the shorts are getting chewed up here. Now, the bond market, we're sitting at a big resistance level right now, and actually coming up at 4.22. If we can push through that resistance level, we could go all the way down to basically 4% on the 10-year Treasury, which would be another substantial move potentially in mortgage rates. On the mortgage-backed securities scene, we actually have a dual level of resistance that we're facing, the 200-day moving average, and then a really sticky Fibonacci level. In fact, we've tried to bounce off this before months ago and weren't able to. If we can get a really solid PCE report, we could see the mortgage-backed securities push through these resistance levels and get to rates we haven't seen since summertime, which would be fantastic. Now, additionally, we talked about Case-Shiller and FHFA coming out with their appreciation numbers yesterday, and those were for the months of September. Today, we got Redfin's October numbers. Redfin showed a 0.7% increase month over month for October. So what that's likely going to show us is when the October numbers come out for Case-Shiller, FHFA, Black Knight, Zillow, we're going to see continued positive numbers. So it's a precursor to that. Now, tomorrow is the all-important PCE report. We are waited with bated breath on what that'll come out to. The better rates are there for the taking. Home buyers, please give us a call. Get pre-approved, get out there, be active right now before just the utter massive buyers come out and start to realize where rates are and what the benefit to them is. Give us a call, 616-293-2189. We hope you have a fantastic day.